We begin with the market's wild ride. On Wednesday and Thursday, the S&P 500 fell more than 5%. The Dow Jones Industrial Average lost around 1,400 points. Everyone was freaking out, Ron. Friday morning, the bleeding appeared to stop and the market bouncing back a little bit. There's a lot to unpack here.
Yeah.
How'd you do this week?
You know, stop me if you heard this one before. These things happen. We're at the end of a 9-year bull market. We've got extremely low unemployment, high GDP, low interest rates for forever, right? Really long period of time. At some point, folks, inflation ticks up, interest rates rise, stocks correct. It's actually quite healthy. It might be painful, and hey, listen, I don't like to see my stocks go down, but it's actually quite healthy. If you don't panic, you stay the course, you think long term, you can actually benefit from it.
Yeah, Jason, there's around the office this week, there's been a lot of quoting of David Gardner, co-founder of The Motley Fool, who said, remember, markets go down faster than they go up, but over time, they go up more than they go down.
Yeah, and I mean, it feels like they've been doing nothing but go up for a really long time. So this is sort of a nice reminder that they do indeed go down and life indeed does go on. I think, honestly, we were talking about this earlier this morning, I think that one of the biggest benefits from coming out of the financial crisis. If you were an investor and you went through the financial crisis, then this is the kind of thing where you can just brush right off your shoulder and just keep on moving along because you understand what's at stake here. I mean, this is why we invest the way we do, because you can't predict when stuff is going to happen. There's not necessarily a rationale for what happened, but it does happen, and you need to be able to maintain your composure, understand that you're going to have some bumpy rides along the way. But again, when you look at that 5, 10, 15, 20-year time horizon, I mean, the market clearly trends in one direction, and it's not down.
But that's the thing, David. I mean, there are a lot of investors who really just started in the last 7, 8 years or so they've never dealt with something like this.
Yeah, this week is a helpful reminder that stocks do indeed sometimes go down. But at the same time, you do have to take a step back and keep this in perspective because the S&P 500 has just fallen back to where it was in July a few months ago. So even though obviously that it hurts to see your money go down more than it feels good to see your money go up, we tend to react in a sharper way to pain rather than the joy of gain. So it's really just, this comes down to the psychology of investing. But when you can keep that long-term time horizon in mind, just remember that the longer you hold, the higher your odds of success over time. There's never been a 20-year stretch with S&P 500 where you actually would have lost money, and that's going through the Great Depression, the Great Recession, multiple wars, and all sorts of other macro events and worries. So the longer you can hold your stocks and the wider your time horizon, the better off you'll be as an investor. But it doesn't take away the pain that you see in a week like this. But I think you, with that kind of perspective, you treat a drop like we've seen this week as more of an opportunity rather than something to fear.
And I think it's also important to note that the stocks that have been the highest flyers are the stocks that have come down the most and actually have a bigger impact on the S&P 500 because of how much they've grown. And I'm thinking largely about the tech stocks, the stocks that you'll often hear called momentum stocks. And by the way, if you buy a momentum stock, you better understand that momentum goes both ways. So what goes up does come down. Common, physics tells us that. Hopefully they go up more than they go down. But when these stocks that have been on a tear come down, they come down rather severely. That can create an opportunity to pick up shares as they get cheaper if you have the stomach for the volatility. Sometimes I see people jumping in a little too soon. They see one day a company drop 2% and they say, oh, time to get in. Well, 2% in the scheme of things, when a stock is up hundreds of percent, it is nothing. But it's important to see what pockets of the market are really bringing the market as a whole down.
Yeah, I think it's really easy to get into a situation like this and get nervous. Particularly if you're a relatively new investor. We like to quote Warren Buffett all the time here. There is one quote where I'm going to push back on him a little bit because, he said something to the extent of diversification is for people who don't know what they're doing or something to that effect. And I get what he's saying there. He's like, if you know what you're doing, then really you can go ahead and concentrate your bets and feel good about how you're investing. I think for the most part, people need to focus on diversification. I think this is a great example of a time where diversification can help combat the emotions that you likely feel in volatile times like these. I mean, we invest a certain way, obviously long-term in mind. We have a lot of those growth names in our portfolio, okay? And a lot of that growth has been pulled forward in these valuations today. So to see them take a hit is not surprising. But if you have some nice, staid dividend aristocrats, for example, in your portfolio to help counter those high growth names, then this volatility becomes a lot easier to stomach.
Well, that was one of the things we talked about last week, Ron, was we're seeing interest rates going up. We're seeing 10-year treasuries at a 7-year high. And, another thing we talked about this morning was just sort of the speed. I mean, it's not just that the market is going down, it is the speed with which we're seeing these drops. And I have to believe that at least part of this is that rise in interest rates and the relative attractiveness of stocks going down ever so slightly.
For sure. Interest rates are a very, very big part of this. And not only do higher interest rates make borrowing costs for companies higher, which lends to them having declining profits as a result of increasing costs, but higher interest rates create alternative investments that make the stock market perhaps less attractive than it looked when interest rates were low. If you can earn 3% at a risk-free 10-year U.S. Treasury, maybe you don't want to own a 2% dividend stock, unless, of course, you think there's appreciation potential on top of that to be had. But you start to think about it a little bit and do the math, and certainly a subset of investors say, I'll take the 3 to 3.5% kind of safe money.
Yeah, I think rising interest rates impact shorter-term investors or traders more than it impacts fools like us who have a long-term time horizon. Like we're often investing with the intent to hold these companies for at least 5 years, and ideally you have 10, 20, 30 years. And in the grand scheme of things, where interest rates go from one quarter to another, 1 year to another, probably doesn't matter as much when you're thinking in terms of decades, not quarters or years. But at the same time, you're seeing all the talking heads on CNBC and TV who do often have a shorter term time horizon. That's all they talk about. So you can't just ignore it, but keep that longer term picture in perspective. And I think the interest rates turn out to be more noise when it comes to the individual companies in your portfolio. And just to double down on something that Jason mentioned about diversification, you just have to remember that the volatility that we've seen this week is the norm, not the exception when it comes to the stock market. So build your portfolio accordingly. Position your portfolio in such a way that you can kind of ignore this inevitable short-term volatility as best you can and keep that long-term time horizon in mind. For some people, that might mean having a little bit more cash on the side to take advantage of market declines like this. It might mean diversifying into some more stable companies like Jason mentioned. But whatever it is, you want to build your portfolio in such a way that you see this inevitable volatility as an opportunity, not something to worry about.
And I'll just add, during times like this, you often hear criticism of the Fed being too tight on monetary policy or wherever. They're always to blame. I would recommend to foolish investors to turn that conversation off in your head. Focus on the companies you own, the companies that you think are great for the next 5 and 10 years. Let the Fed do whatever the Fed is going to do. It's out of your control anyway. Just stay as a long-term investor.
It's kind of laughable when you consider that a few years ago the Fed was being criticized for cutting rates.
Right. And they can't win. It's a miserable job.
Yeah, I'm sorry. You can't have it both ways.
Right.
You can't say the economy's the strongest it's ever been and then in the next breath say, but please don't raise interest rates 0.25% because we're so fragile, we'll just be destroyed.
Yeah.
I should point out that we are taping this in the middle of the trading day on Friday. So while the market was up in the morning, who knows where it'll end up. So fingers crossed it ends in the green. But let's just go around the table because one of the things that we talked about in our planning meeting this morning was we were kind of hoping to see a little bit more of this, and who knows, depending on how next week goes, maybe we'll get more of that. We're looking for opportunities, particularly if you've got a little cash on the sidelines, if you've got a watch list, and by the way, this is why we do Stocks on Our Radar. This is why we have a watch list. So, Ron, I'll just start with you. What's a company that you've got your eye on that if it fell 20% next week, you wouldn't be too upset?
Yeah, people think we're disingenuous when we say we wish the stock market market would have kept going down. But it really is true. You know, I've had a lot of cash on the sidelines waiting for opportunities like this, and I'm under allocated in some of those high tech stocks I mentioned earlier, and I'd love to get in on them at cheaper prices. 20% lower would be awesome. So a company like Twilio, TWLO, they make applications that arm developers with the tools to embed communications like text, voice, and video. So like the WhatsApp app of Facebook uses Twilio's applications. I'd love to be an owner of that stock, but at the right price.
Jason?
Yeah, it was an easy one for me. I'm already an owner of IDEX Laboratories. The ticker there is IDXX, but I would certainly love to pick up some more shares at a cheaper price. IDEX is the market leader in the pet diagnostics equipment and testing market. So they get a lot of those big razors, the equipment, into veterinarians' offices, and then they sell them those blades, the consumables, in the form of those diagnostic tests and whatnot. I have a veterinarian that uses all of their stuff, swears by it, and my 3 dogs at home seem to be very happy and healthy, Chris. So I'm going to take his word for it.
David?
I'm looking at Match Group, kind of in a similar boat to Ron here. This has been a high flyer. It's been an incredible stock, but still trading for close to 40 times forward earnings. But this is a company behind a portfolio of dating sites and apps like Tinder and its namesake Match. This is really getting to be a business that's printing cash. Free cash flow has more than doubled over the past 4 years, expanding globally. They have a subscription model that they're rolling out with Tinder that seems to be doing really well so far, finding ways to increase user engagement both in North America and around the world. So that's what I'm keeping an eye on.
And I'll just add, the first thing I did when the market started turning south is I checked our internal system to see if I was clear to buy the S&P 500 and the Russell 2000. Nothing wrong with buying an ETF, a broad-based index.
With a nod towards a theme we've talked about for a while now, the war on cash, I will simply say that I would not at all be upset if Visa and MasterCard had really bad weeks.
That's good options.